the discount to NAV is a very simple measure to talk about the secondary market price. We always observe that sellers are very much focused on the net asset value, which is maybe just like an accounting measure, whereas the buyers are much more focused on cash flows and what they actually get back. So we would often advise sellers also to get a bit of a better grasp on what they actually can expect going forward, and not just look at the accounting perspective. What we do observe is that particularly the 2009 and newer funds are rather trading at par and, for very sought after names, even above. And if you go pre-crisis, 2008 and earlier, we clearly see at least 50% of the funds trading at a discount of 20% or larger. It's fair to say that the valuation of the underlying companies of venture funds are seen by many as frothy or just exuberant. And you also need to see that most people, let's say in the secondaries industry, are more value focused, cash flow focused. So they tend to maybe not see the huge visionary or the huge scalability of many of these companies. But we clearly see quite a lot of supply on the venture side, also from older vintages, as really people or investors believe they can get good value now for venture funds that are marked at very high levels. The fund of fund secondaries were really an extremely small niche until, I would say, 3-4 years ago. If you look at it, many of the secondary buyers are also fund of funds or are part of a fund of fund group. So they were often seen as competitors. And so it was quite difficult sometimes to get a transfer done. Today, there are established and specialist secondary buyers just for fund of funds, which do not themselves have a fund of fund primary business. So it makes the market much more efficient now, as these are clearly not seen as competitors by the GPs, and transfer approvals are much easier to observe. In both infrastructure and real assets, you do have an even larger dispersion among the different quartiles, particularly because in infrastructure you also have quite a lot of emerging market exposure, for example. And so there could be funds that have really massively underperformed and may have a TVPI of 0.4 after 10 years. And on the other hand, there are huge successes. And I think there is even more idiosyncrasies within that space, particularly in the infrastructure space, compared to the buyout space, which is just more driven by the overall economic developments in the equity market.